Hi, welcome to our monthly webinar. If you can hear me or see me, okay, loud and clear, and you can see me clearly, please type yes in the chat box right now. Okay, thank you, Michael. Thank you, Dylan. Thank you, Ken. Okay, so I believe most of you can see me and hear me, and I really want to say good evening to you and welcome to our monthly webinar. In case you don't know me, my name is Victor Cheng, and I'm the co-founder of the Fifth Person. Okay. And today our topic is going to talk about what you need to do if your portfolio is in red. Okay, so I'm going to switch my screen to the PowerPoint slide. So let me switch it now. Give me a minute. Okay, if you can see the PowerPoint slide right now, please type yes in the chat box. Please type yes in the chat box if you can see my PowerPoint slides and hear my voice. Okay, I don't see anybody typing yes. Can someone type yes and let me know whether you can see my okay, I saw. Okay, thank you so much. So I'm going to start with the presentation for today. So I'm often been when I'm running the seminars or workshops, and people always come up to me, and ask, Victor, I've been investing for many years, but my portfolio is still losing money. Okay, and what should I do about it? So these are types of questions that I get very, very often. And when I take a look at their portfolio, right, they usually have like more than 50 companies in their portfolio, or some of them maybe have 70 or 100 companies in their portfolio. Okay, and when I look at majority of the company they invest, right, are usually weak business with very, very poor fundamentals. Okay, so and most of the time, right, they bought it based on friends or brokers recommendation. So I was very fortunate, that during my early years of my investing with Rusmin, we are tasked to turn around a loss-making fund. Okay, and I remember that at the point of time, the fund was making a 400,000 losses, negative 400 Sing dollar losses. And by the time Rusmin and I left the company, they grow into a 2.3 million profit in just 3 years. Okay, after we do the restructuring for them. So combining with our previous experience and our investment style, which we evolved from the old style, we continue to help some of our friends to actually turn around their portfolio. And this all can be done by just following 5 things that I'm going to share with you today. Okay, so before I move on, I'm going to share the usual disclaimer. Okay, so basically what this disclaimer is, because whatever I'm sharing today is not a recommendation of buy and sell. Okay, because in the later part of this webinar, at the Q&A segment, I'm going to be talking about companies that you guys have submitted in your portfolio. Okay, I won't be naming anybody. I'll be just talking frankly on my personal opinion. Okay, it's not a recommendation of buy and sell, and sometimes I can be very harsh in talking things because I base on a certain principle of my investing style. Okay, so there's no right or wrong, but you can just listen and see whether it suits you or not suits you. Okay, so let us move on. The first thing about investing the first thing about turning around a portfolio is to always compound your winner, not your loser. So one thing I realized is people who have a losing portfolio usually hold on to their loser. Okay, because they think that one day the loser will turn around and they'll make back money. So just take note that when I talk about loser, when I talk about loser, are usually companies with weak fundamentals or very poor business model. Okay, I'm not saying that company share price making losses, that is loser. Okay, sometimes good companies, they also make losses in their share price. Okay, and after some time you just rebound back. So share price will fluctuate up and down. So when I talk about loser, is usually companies with weak fundamentals. So for example, right, my father used to bought stocks many years ago, and I can't remember which company he bought, but I remember he invests close to about 100,000 Sing dollar in one of the company. Okay, and I think he used his CPF money to do that, and because it was due to some friend's recommendation, and the company he invests, right, I confirm no one, because when I looked through the company, I was like, the business is very lousy, poor fundamental, heavily in debt, and eventually my father actually make losses in those companies. Okay, so because he always thinks that these lousy companies, right, will eventually turn around. So I think he hold on for, I think, close to, I think, 10 years, and eventually those companies didn't turn around, and he, by the time he sold and recovered the value, I think it was about 10,000 plus Sing dollar. So he literally lose more than 10 times downwards. Okay, and that is very, very painful for my dad. And the first thing you need to do in order to turn around your losing portfolio, you should always clear your loser first. When I say loser, it's the weak companies. Okay, fundamental weak companies. So as an investor, right, you should always invest, based on probability. So next, you need to ask yourself, what are the chances that a company will recover or do better in the 10 years time? So you look at your portfolio, you tell yourself which company, have very, very high chance, to recover or do better in 10 years time. Okay, so it's split in between two companies. One is the strong business model and one is the weak business model. So if the company have a very, very weak business model, and you hope that the weak business model company will turn around, and the probability, if you ask yourself from now to 10 years time, will it go up or go down? For weak business, right, I can tell you the probability of them going down, right, is very, very high because of their business structure. Okay, so the probability is very, very high that they will go down. But if you cut your loss right now, okay, and you invest in a strong business model, which has very, very high probability that in the 10 years time they will go up, right, you would have made back your losses. Okay, and even, right, break even or even make gains. Okay, but if you continue to hold on to your losers, the weak companies, 10 years down the road, you are still losing money. Okay, so that's an opportunity cost. If you continue to hold on to losers, you are basically compounding your loser, not compounding your winners. Okay, so remember, always hold on to your winner, but cut off your loser. Okay, so how do you know which company you want to clear off from your portfolio? So basically, I always create this table. I always look at this table that I created. So I always want to, the first step is to classify all these companies in your portfolio into these four categories: recurring, non-recurring, weak model, and strong model. So you must understand the company's business model. You must know how they make money, and you want to know whether they are recurring or non-recurring. And you want to make sure that the company you invest have a strong business model. So my objective, right, is to keep companies under the strong business model column. Okay, and eliminate those that are in the weak business model column. Okay, so if, okay, you realize that this company, right, the business model is very weak, immediately clear them. That's how I do it. Okay, and that's how I turn around portfolio most of the time. I clear off the weak one and I keep the strong business model. Okay, so just take note that companies that landed in the recurring and strong business model box, right, is the ideal type of company that you should keep. So we are targeting the top right hand corner. Okay, so that is I would say the ideal companies. But of course, the non-recurring that have strong business model also is a good company. But you must know how to buy at the correct time and at the correct price. Okay, so you cannot discount them out also. So if you follow the process through, right, you should be able to generate excess cash. Okay, why do I say that? Okay, because if you start clearing off those weak business model company, right, suddenly you have a big pile of cash. Obviously, I hope you have a lesser pile. If you have a big pile of cash, that means your majority of your business you invested in are actually weak business. So that is generally quite sad, right? So, but if so happen that you really invest majority of your money in weak businesses and you got a large pile of cash, that is also a good thing. So you can start now deploying all these company into good companies, which move on to step number 2. Okay. Step number 2 of turning out your portfolio is to always invest in good companies. Okay, because you don't want to make the same mistake again. Because your first step, you clearing off your loser. If you continue to invest in weak companies, you will continue clear your loser along the way. So you must switch it to invest in good companies. So now with the excess cash that you clear off from your loser, right, you have to focus on this kind of good company to let it compound. So when I talk about good companies, right, they are usually companies, right, with what I said, strong business model that have recurring earnings. Okay, this company usually have strong market position, so they are either very big market leader or maybe the second or the third. Okay, and they have been generating good return on equities, and they use very little debt inside their balance sheet. And usually they have very strong cash flow and allow them to give excess cash back to as dividend to the shareholder. Okay, so this is exactly what we do when we turn around losing portfolio, because good companies give you high probability of success. So this is what we look for. Okay, also next thing I want you to take note is that buying into a good company, right, is good, but you have to always pay at the correct price, the right price for the company, because a good company can be a bad investment if you pay at the wrong price. Okay, it may take you many years to break even if you pay at the wrong price, if you pay very high price. So for instance, if you are invested sets, okay, Singapore airport terminals, which do the food catering for all the aeroplanes, right, during the IPO, and you hold it for 10 years, right, you just break even only, because during the IPO at very high price. So they start to make money, you double up in 15 years. So that don't make sense for you to buy into a company. If you still can make money out of investing in good company, just that you don't make a lot if you buy at the wrong price. So you must always buy at the correct price for good companies. Okay, so the simple rule of thumb is never overpay for a quality assets. Okay, you try to buy quality assets at a reasonable price. Okay, the next thing I want to say is why you want to invest in good company is the thing about being a part-time investor like you. Okay, so I have to be frank, all of you are, retail investor, you have your own job and you're doing investing for a part-time. Unlike me, I do it for full-time, so it's a totally different thing. Okay, and as a part-time investor, right, being as passive as possible is very important to you, and because you have very limited time. Because imagine you go to work and you come back, you still need to do research and analyze companies, right? But if you invest in a lousy companies, then every day you see the share price drop because the company's business model is lousy and you do not have faith, right, in it, and you start to worry so much and you got sleepless night. So investing in good company, right, will definitely give you a peace of mind. Okay, and you don't need to worry so much because you know that the company you invest is very strong, and they generate strong cash flow and they give you good dividends. So even though there's a temporary setback of company, you'll definitely recover because you got a peace of mind out there that this company is good and is safe and sound when you invest into them. So that's the reason why you should spend your time looking for good company instead of buying a company with business model. You still can make money out of companies with they are not so good, okay, but you must pay a very cheap price. Okay, so and most of people they cannot sleep well once they invest in lousy company. But if you invest in good companies, you can sleep well. Okay, so now let's move on to step number 3. Step number 3, right, when I invest, right, when I turn around a portfolio, the important thing is be diversified. You have to diversify your companies. You cannot concentrate on maybe everything into one company. Okay, you have to diversify, but not over diversified. Okay, so portfolio diversification, right, is very important for investing. Okay, because it helps you to minimize your risk. And there's 2 types of risk that you can find in the market. Okay, one we call the non-market risk, the other one we call the market risk. So non-market risk is something that an investor, right, can control and minimize. Okay, so portfolio diversification is used to minimize non-market risk. And non-market risk is usually associated with the company's financial performance, okay, the fundamental of the company. While market risk, right, is like big due to maybe market crash, or maybe a flood come and hit the company's factory and cause its earnings go down. All this is out of your control. You cannot control them one. Or political stability is not there, or economic recession. All these are not within your control. So portfolio diversification won't reduce market risk. But what you want to do is you want to reduce non-market risk. So that's you use portfolio diversification. Okay, so like I said, most investors, tend to over diversify their portfolio by investing. I see a lot of investors, they invest more than 50 companies. And let's be honest, right? To continue to monitor more than 50 companies, when most retail investors are only part-time investor, it's very, very hard to manage. Imagine you come back from work, you still need to spend your time monitoring 50 companies. It's very tiring for you. So may as well you concentrate your power on a few companies. Okay. So what is the sizable amount you should have in your portfolio? That's the key question. How many companies should I invest? That leads us to the next slides. Okay. So in 1972, right, Nobel Prize winner William F. Sharpe actually make a study on portfolio diversification. And his research shows that, when your portfolio size, right, hit 30 companies, right, the risk reduction is almost very, very little. Okay. So this means that your ideal portfolio size, right, for diversification, right, should be between this range, 10 to 30 companies. Okay. So it's up to you. You can invest to 10 to 30. Okay. But I think as a retail investor, 15 should be a very, very good figure for you. And when you invest, right, you have to be equal on each percentage. So let's say you got 10 companies, right? You don't invest 50% in one companies and the rest in the other 50%. You don't do that. Okay. If you got 10, you got 10, you want to invest in 10 companies, each one of them 10%. You have to keep the percentage equal. Okay. You cannot one higher or one lower. If you tell me one higher by 1% and one lower by 1%, it's okay. But you cannot be one 10%, another 20%, another one 30%. You cannot do that. Okay. Your job is try to make them as equal as possible. So if you have maybe 15 companies, should be about 6 to 7% each company. That's your max. Okay. So, and you also need to take note that majority of all the companies you invest, right, majority should put in recurring business. Companies that are strong business model, they are recurring instead of non-recurring. Okay. So that's your focus, so that you know that even though non-recurring business didn't perform in the end, right, your recurring will be there performing because they host the large percentage of the portfolio. Okay. So now, after you do all these 3 steps, right, the next step you need to do is to let your tree grow. Okay. So there's always a difference between, investor expectation and reality. Okay. So this is the investor expectation and reality. So most investor, right, they expected that, when they buy into this company or they buy into this stock, they expect the share price to go like this. Okay. This is what most investors expect, your share price to immediately go up. But in the reality, right, it's not the case. In reality, right, when your share price should goes up like this, you go through a period of flat, then suddenly you just go up. You must understand about investing in stocks. When you invest in stocks, right, you're investing in business. And business don't always do well. Business goes through up and down, but in the long run, they build up their moat and suddenly they become very, very strong. And that's why the share price and the fundamentals and the earnings all go up, because it takes a long time to build that that competitive advantage that they have. Okay. So you have to take note that it needs time to grow when you invest in a company. Okay. So let me give you a easier example. So investing in a company is just like, you're planting a small trees. Okay. Even though the trees is very small and these trees are all deep rooted into the soil. Okay. When I say deeply rooted, that means strong fundamentals. Okay. The deeply rooted represents strong fundamentals. Then you'll start to monitor the tree every quarter or annually. Okay. Which means that you look at their quarterly report, you look at the annual report, to ensure that the company continues to stay deeply rooted while the company grow. Okay. So while waiting for the tree, to grow bigger, right, you also enjoy the fruits, which is the dividend along the way, So they bear fruits along the way as the tree keep growing bigger and bigger. So the growth process of tree, right, require time. Okay. You don't expect, the small tree suddenly overnight become a big tree, right? right? So it's exactly the same for investing. You should not expect the company you're investing, right, to suddenly shot up in share price. Okay, so good companies continue, to grow and to build their moat every single day, and that requires time to achieve it. Okay, since the companies are like small tree, it's very important for you, to be patient and to focus on the long-term prospect of the company, despite they having tough time. But you know that the company is good, and eventually you can reap the profits. Okay, you can reap the future gains. That means you cut down the trees, or you continue to bear more fruits. Okay, so once you have been patient, right, this lead us to the last step of turning around your portfolio. Okay, opportunity is the key. Okay, so one of the common question I always get is, Victor, I'm holding too much cash right now, what should I invest in? Okay, so when investors are holding too much cash, right, they are always feeling very itchy, and they want to deploy the money very fast, and they always scared to lose out, to people, other people is investing, and I scared to lose out. Just like now, everybody, the past few months, everybody's investing in Bitcoin. Suddenly, a lot of people feel they are losing out, and everybody rush to Bitcoin. Okay, so these are the feelings, that emotion, that I would say greed, that cause people to make mistake. Okay, so to achieve a profitable portfolio, right, opportunity is the key to success. You should only invest when the opportunity arises. So opportunities such as, economic crisis, the picture right here, you got Asian financial crisis, dot-com bubble, SARS, global financial crisis, Euro debt crisis, Chinese stock market crash. All these are opportunity for you to invest. And for the past few years, it happens so often. Okay, and when this opportunity happens, right, this economic crisis or temporary setback of the companies, right, will cause the company's share price to plunge. Okay, and your plunge below its intrinsic value. Okay, so it's important that you also must know how to calculate the intrinsic value of the companies. Okay, so once it plunge down below the intrinsic value, and that's where you buy into them, and you invest in them, and you wait for recovery, and eventually they'll recover. Okay, so you always have to be patient to wait for the opportunity. Okay, and make sure that they hit it below the intrinsic value. So let me give an example. So you remember the just now earlier on I talked about the portfolio that we turned around from a negative 400,000 all the way to 2.3 million. So I remember during that time, right, when we start clearing the portfolio, we are quite lucky, because the time when we cleared the portfolio, we clear all the non-recurring business, we clear all the lousy business, and we suddenly got a big pile of cash. And at the point of time was the Euro debt crisis. Okay, 2010, 2011, which you can see from the table right here, the Euro debt crisis, which they decreased by from the peak to trough of 23.7%. Okay, and the market at the point of time was very cheap. So we are able to deploy most of the cash, and after that, we wait for the company to recover. And eventually, 2 to 3 years time, the companies are all recovered, and we make the money back. So don't be too eager to invest in any companies. Okay, so that is the key to investing. Okay, and to turn around your portfolio. Okay, so now I come to the end of my presentation, and I'm going to move on to the Q&A segment that you guys have submitted to me. Okay, so give me a minute. I will switch the screen. Okay, if you can see me right now, please type yes in the chat box right now. Can you see me? Okay, good. So now I'm going to take out all those wait, I'm going to take out all those companies that you shares about. Okay, good. So what I'm going to do now is I've received a lot of companies. Okay, literally a lot of companies. And what I'm going to do now is I'm going to go through some of them. Okay, I do not know whether I have enough time to go through all of them, but I'll try to cover as many as possible. Okay, so I'll go through the different companies, and I'll tell you my personal opinion about the company, but it's not a recommendation of buy or sell. Remember, it's not a recommendation of buy or sell. Okay, it's my personal opinion. Okay, And I realized most of the portfolios that send me, right, a lot of them have telco business like M1, StarHub, and Singtel. And most of them in the portfolio, you're making losses in these three companies. Okay, am I right? I think most of you are making losses in these three companies right now. So give me a minute. Just switch to my screen. Okay, so you must realize the telco industry right now in Singapore. Okay, they are facing very, very strong competition, and they also have digital telcos like Circle.Live, and the fourth telco haven't even entered into the market yet. Okay, and between all these companies, right, M1 is the weakest among all of them. Okay, and because they only fight by pricing, and I personally think that they are going to be affected the most. And while Singtel have actually regional presence in the not only in Singapore, they also have dominating presence in the regional of the telco. And StarHub is the second biggest telco in Singapore, but they used to have dominant position in cable TV. But the issue right now is a lot of people are watching things online, and their cable TVs are not doing as well. And moreover, I think recently their CEO resigned, and that's a very, very big concern to me. Okay. One thing I know for sure is recently Rusmin actually told me that he renewed his star plan, and he renewed a 2-year contract. And it's like the hubbing plan, okay, the cable TV, the broadband, and the mobile phone. And StarHub gave him a very, very big discount, and they lock in for 2 years. So by doing so, right, I know that the next 2 years, right, StarHub revenue will drop by that percentage, which is true. Now they are dropping that percentage because they start to lock in more customer right now at a lower price. So, and they all lock in advance one. So you know that their revenue in the future will definitely goes down, and their profits will definitely go down. So that's one thing I concern. Okay, not only StarHub, M1, Singtel, everyone is doing it. Okay, so you can expect the telco business to be very, very tough moving forward. And after the fourth telco come in, it's going to be even more tough. I'm not saying that the telco business, you cannot invest. Okay, you still can invest, but you must buy at the correct price. Okay, and right now, I don't think I want to be in the telco business right now, because the yield that they are giving out is not high enough, and the share price have not fallen more enough for me to buffer any losses, especially for companies like M1 and StarHub. These two, I'm very worried. Singtel still not so bad because they are not only the local telcos, they still got the rest. So that's my take on the M1, StarHub, and Singtel. Okay, so now I'm going to move on to the next company that I see most of your portfolio have is QAF, this company. Okay, actually Rusmi and I, we actually look in the QAF before, and after the share price fallen a lot, we are very tempted to buy into it, but in the end we didn't choose to buy into them. Why? Okay, because their pop business, right, if you know, right, in the past few years have been making losses. Okay, then all these accumulated loss, right, that they done, right, based on accounting, right, will raise into tax benefits. So when the company turn profitable, right, all these tax benefit, right, will goes into the profit side. Okay, so in 2016, right, the company actually used the tax benefit. Okay, so that's why in 2016 you can see their profits are very high because of all those tax benefit they have. But they will not be enjoying the tax benefit in 2017, 2018. So of course, if you use the tax benefit, you include the tax benefit inside, right, QAF definitely look cheap. I would say it definitely look cheap. But if you remove the tax benefit, which you know that is one-off thing, right, actually the valuation for QAF, right, I would say it's fair valuation. It's not very cheap, but it's fair. So that's why we did not purchase into them. Okay, so I mean, if you have bought QAF at a fair value or below, it should be okay. But of course, I always prefer to to buy below fair value, unless I felt that the company business model is super strong. Okay, then I'll pay at fair value. If not, I try to always buy below fair value. Okay, for QF case, I prefer to buy below fair value. Okay, so let's move on to the next company. The next company was I can't pronounce this company's name. It's a Malaysian listed company. It's called HivaBot. HivaBot, is it? This is how you pronounce it. Okay, so somebody submitted this company, and just take note that all these company I talk about, some I got in-depth knowledge. I'll tell you as much as I can, but some of them, because you just give me in recently, and I have to just do a quick look at it based on my quick screening, the way I see things. And I look at HivaBot, I realize they are in the manufacture, trade, and distribution of this thing, this wood called particle board. Okay, so they usually they are quite similar to furniture player. I think their materials are used in the for furnitures. And personally, actually, I don't like furniture business because I think that they can be easily copied. People usually compete by price, so it's a very tough industry, and it's not recurring. Okay, you don't see people keep moving house or buying new furniture. Okay, and I don't think this company have a moat too. But of course, if you have bought at a good price or even fair, what I mean is if you have buy a good price, even a fair or a lousy company, you still can make money out of it. Okay, so everything still boils down to the business and the price you pay. And if you look at HivaBot, right, their share price have been performing, plus their company's fundamentals. So which means that the earnings and the revenues are running up. I think they are able to perform so well in the recent years, right? Also because of the ringgit depreciation. So if you look at Malaysia, right, most of the export business in Malaysia, they tend to do well these few years because of the ringgit depreciation. Because when you export, right, it's in the US dollars most of the time, and the ringgit depreciate, and when they sell overseas, they make more money. Okay, so that's what I think that the company have been performing the past few years. In the past, I think they're just a fair company, not so good. Okay, but the good thing about this company is they're actually in the net cash position. Their ROE have been, in a single digit most of the time, and recently because I think because of ringgit depreciation, they actually been making double digit ROE. But of course, they are also trading in a single digit with at least a 6% dividend yield right now. So one thing is my concern, I would say, about this company is how long they can ride the weak ringgit trend. Okay. Moreover, if their business is not recurring, type, I believe, right, such business are more cyclical because now they are enjoying the tailwind of the business. Okay, they are not experiencing headwind, but they are enjoying tailwind. So whatever they do, right, they just make money. And like I said, I think this business is more cyclical. I look at the past record, their earnings are up and down, very cyclical. And one thing I'm very scared about investing in cyclical business is that you don't know you invest in the which part of the cycle. And one thing about the cyclical business is that they tend to have very low PE during the close to their peak of their cycles. And right now, these companies have low PE and high yield. So, and I don't know whether is at the peak of the cycle or not. So that's one concern that I have about this company. So, but of course, if you ask me if I want to have this company in my portfolio, I will never put this company in my portfolio because it's not the type of company that I want to invest in. Okay. So next, I'm going to move on to another company that I see most of you have inside your portfolio, which is ComfortDelGro, the taxi business in Singapore. So the taxi business in Singapore, right, have constantly been disrupted by Uber and Grab. Okay, personally, I've been taking less taxi but more Grab and Uber, and the taxi business actually accounts about 30% in ComfortDelGro's business. So they are not only taxi, so they got other stuff also. Okay, and after Uber and Grab came in, right, it's very competitive for the business. So if you want to be very conservative, right, investing is all about protecting your downside and be very conservative in the in the way you value the company. Okay, then if you want to be safe, you need to find a base. Okay, how much base that you can be there. Okay, so you want to assume that the whole 30% of the taxi business are being disrupted. That means they totally take out. Okay, and what's the possible earnings that they can give you. Then assume they give out the same amount of payout ratio based on their earnings. Okay, and what's the yield you can get. Okay, but of course the taxi business will never totally disappear. Like it will still be there, that's all only. Okay, and ComfortDelGro is definitely a good company. It's just that you must buy at the correct price. Now they are facing very, very headwinds. Right now the price look a bit attractive, but I prefer a higher yield because now the price, right, give me a yield of maybe 5.1%, and their payout ratio have been, and they pay out 5.1% is based on a higher payout ratio, you know, because they tend to pay out higher payout ratio to fit the yield now. Okay, because I don't think they are doing well for their taxi business, and I want to have more buffer, you know. So if I look at ComfortDelGro, right, I want to have at least about 6 to, you know, maybe 6 to 7 or 8% yield, very high yield. Okay, so in case the taxi business continue not to do well, the earnings drop, the dividend cut a bit. Okay, at most my yield will drop down by maybe 1 or 2% to maybe 5% or 4%, right? I still can make 4-5% yield. It's quite decent. But if you invest in maybe 5 or 4%, it drops 1 to 2%, it becomes 2 to 3%. Okay, that will be very painful for you, and that don't justify yourself to be holding on ComfortDelGro. But of course, a lot of my friends, they bought ComfortDelGro at a very high price. I think they bought at 250 or 270. And personally, when I look at that amount and I look at how they're being disrupted, I wouldn't even want to look at ComfortDelGro. So until now, we haven't bought ComfortDelGro. We are waiting for the right price to go into ComfortDelGro, the right dividend yield that we want to buy into ComfortDelGro. Okay, so I will still continue wait for ComfortDelGro. Okay, I think they are very close to my good price. So like right now it's about 5.1% yield. So maybe you want to look for maybe 7% yield will be good, 7 or 8%. So there you can buffer a bit. Okay, so that's what you should look at. Okay, next let me move on to, okay, somebody actually talk about Ecoworld International, but I can't comment much on the company because this company actually recent IPO, and I don't really touch on IPO companies, and they not much of track record, so I cannot talk much about this company. Okay, there's another Malaysia business which is in a construction business. It's called Ecovest. Ecovest, Berhad. I don't know did I pronounce correctly. Ekovest. Berhad is construction business. I look at the business, have been quite profitable, able to grow their equity base, but the earnings itself is not recurring. You know, construction business are generally more cyclical, project basis, non-recurring, but the company have been paying quite good dividends. So for a property and construction company, right, I think you should use price to book ratio to value this company. And when I look at the price to book ratio, right, they are currently trading above their average PB ratio. Okay, so it's not undervalued in my eye right now through my quick screening. Okay, and I just got one concern only. Okay, is their debt level, right, have been increasing. Okay, and it's quite high right now. And looking at their latest debt to asset, right, is around 70%. Okay, which is a very, very huge red flag for me. So anything wrong, right, the company, right, may go into financial issue, or they may do a cash call from they may do a rights issue from the shareholder, or they may issue or do placement shares, okay, to cover their debt. So I'm very concerned with their debt. Because of this debt, right, if I were to look at this company right now, I will never invest in this company, because I think that the risk that I'm taking is very, very high, because you don't know whether the company may or may not go into financial issue. But based on my statistics that I always do, companies with this high amount of debt to assets, usually they are very high chance to go into debt issue. Okay, if that means they are running on they are standing on very, very thin ice. Okay, anytime they can go both way. That's all. Okay, if they're lucky, they can go up high. If they're unlucky, they will just go bankrupt. Okay, this is one concern that I have for this company. Okay, so I won't be looking at this company. Okay, so next is let me see, next company. Okay, I saw somebody's portfolio inside have FSL Trust. Okay, long time ago, when I was still venue, I invested in FSL Trust, and we of course make losses, and we cut losses on this company. And I personally, I don't think this is a good company. Why? Because they are in the firstly, I don't like business trust, especially shipping trust business, okay, is it's not very good. Second is the people who set up FSL, right, are professionals, and they do not know anything about the ship market. And when they bought the ship, right, they bought at all the very, very high price. Okay, and they run the company so badly. And of course, now the whole board of FSL changed into another company. And I can tell you, shipping industry is very tough, and I will not want to be in. Okay, so that's why in the past we actually sold away FSL Trust. Okay, next is I saw people's some of you, most of you, I'll say, have SPH, Singapore Press Holding. Okay, the newspaper business in Singapore, that have been dropping. Okay, if it's me right now, I won't be looking at SPH. Okay, why? Because SPH media business has already been disrupted. Now people, when they do advertising, right, business that they do advertising, which majority of their incomes come from, right, people are using Facebook to do advertising, and it's much lesser cost and more targeted and better result as compared to newspaper. Okay, and moving forward, youngsters are reading more digital stuff instead of newspaper. And if they want to transit to a digital platform, which they are transiting right now, on the digital platform, right, they cannot charge the advertising fee as high as they charge in the newspaper. So you can expect their revenues and net profit continue to drop due to their media business. And this is the reason why you can see SPH is trying to diversify into properties and other stuff. Okay, I won't be shocked if one day SPH become a pure property player and the newspaper becomes a very small portion of their total revenue. Okay, so right now I'll stay clear from SPH. I will not want to go into SPH. I'll wait until assuming that their whole business media is gone. I want to buy based on their property price, the property revenues, and the profit that they can give, and I see what's the dividends from there. Okay, so I won't be looking into SPH right now. Okay, next, I think somebody's portfolio talk about Amway inside their portfolio. So when I look at Amway, I don't think they are fantastic companies. I think they are a decent company giving you a 2.5% yield. Personally, Amway is in a MLM business, multi-leveling business, multi-level marketing business. And personally, I don't like MLM because they actually actually their products are very cheap one, but they mark up the price very high and they sell it to people because they need to give commission to their distributors. So share price have been going down recent years because their margins have been squeezed. You know, they buy their products from import from overseas, and of course when Malaysia ringgit depreciate, their import costs are much higher because they are within Malaysia. So their margins used to be double digit and now become single digit. Okay, but the plus point about this company is they are in net cash position, okay, and zero debt. So this company will definitely not go bankrupt, and they every year make profit, so not so bad. So these are the type of company I would say deep value companies. That means fair companies, but I won't buy it at a very, very big discount. Okay. So the key thing about this company is when can they recover back to their past glory? Okay, it's hard to predict now. Since so many things is affecting them, and moreover the dividend yield is 2.5%. Getting 2.5, that means you buying this company, you get 2.5% every year and you wait for it to recover. I think does not make sense to me. If I want to wait, right, for the company to recover, right, I rather wait with a higher dividend yield. Okay, and moreover with 2.5%, right, they are already paying 80% of their earnings. Okay, their latest earnings. So you should demand a higher yield for such companies. Okay, so unless this company become very, very cheap, right, then you can maybe consider looking at Amway. If not now, right now, I probably wouldn't want to invest in Amway. Okay. Next is this company called Teosing Capital. Okay, Malaysia listed company. Teosing Capital. They sell egg. Okay, basically they own a chicken farm and they lay egg and they sell egg. I don't like about this business is the business have a net debt. It's in a net debt position and it's heavily geared. Okay, they got a lot of debt inside their balance sheet and it's close to 0.9. That means 90% of the equities are actually debt. Okay, and this company, right, because chicken have a shelf life one, so I think the chicken's average life is about 5 years. After that, after they lay 5 years, you have to kill them, or they die, or you kill them. Okay, even before the chicken die, you have to kill them and sell the chicken off. Okay, so it cannot be you 5 year, but the average life is 5 years. So that means maybe you buy the chicken, right, 2-3 years you have to kill it already. Or maybe 4 years you have to kill the chicken and sell them for food. Okay, and this company have to consistently spend money in capex on. Okay, so one of their capex disappeared, they have to keep continue spend and replace it. So it's very capital intensive business. So I may not like these cases. Okay, and of course it sales is goes to Singapore and Malaysia. So that's the two places that they go. And of course recent years they have been doing well. Same export business, ringgit depreciate, they make more money. Okay, and if you want to buy them now, I don't think so. You buy a highly geared company at a 1.6% dividend yield, and they have to consistently spend money on capex. I won't want to look at this company. Okay, that's my take on it. Okay. Next is I seen some of your portfolio. Some of you actually lost a lot of money in Marco Polo Marines, and even in Noble Group. Okay, Marco Polo Marines is in the oil and gas. I think Noble Group is more in the commodity. And Marco Polo Marines, right? There's a lot of oil and gas business that I saw in most of your portfolio, and I don't understand why you guys never clear. You should have cleared the portfolio when the oil price dropped, because the oil price dropped based on the supply more than demand. And one thing I learned about this, right, is that in an oversupply situation, it may last a long time. You don't know when you recover. Okay, it's better to be in a shortage situation instead of an oversupply situation. Okay, because in a shortage supply situation, right, the price of the products will keep going up. Okay, but in an oversupply situation, the price of the product will keep going down. And that's what happened to Marco Polo Marine. So if I know the oil price crash, I immediately clear all my oil and gas stock. Okay, I won't want to hold them. And moreover, Marco Polo Marine now go into recapitalization. That means a lot of new shareholder came in, put in more money, and recapitalize the shareholding structure, and they dilute all the old shareholders. So the founders who I think actually more than 50%, and now dilute until 6%. So if you are also a shareholder, you've been diluted until very, very badly. So I want to stay in this company because I felt that when they go into such issue, right, the management itself is not conservative from the start when they manage this business. And if you want me to put money back to trust this founder again, I probably won't want to do that. So if I were you, I would just clear Marco Polo Marine. Noble Group, this one company that I do not like. They raise more capital than they give it back to you. And their structures are very, very complicated. And of course, they have been hit by a lot of short sellers talking about them being a fraud. Okay, you don't know whether they are fraud or not fraud, but they create a lot of loophole for people to come and attack them, and their business model is very, very complicated, and they consistently, like I said, raising capital. So last year, my dad asked me to look at Noble and asked me to buy for him. Luckily, I stopped it because after that, the Noble price actually continued to drop further. I won't want to look at Noble, and I won't want Noble to be in my portfolio. I'd rather take the money and put it somewhere else. Okay. Let us move on. Next is this company I saw in one of the participant portfolio is WCT Holding Berhad. Okay, basically this company, right, is a construction property development business, not recurring, very lumpy, cyclical, highly geared business. That means a lot of debt, and yet this company have negative cash flow. Okay, and this company consistently raising capital from the shareholder, and I personally felt they managed very badly because you have to consistently raise money from the shareholder, and yet your debt level is still so high. I think the management didn't manage the company well. So I won't want to have WCT Holding Berhad in my portfolio. I'll clear them off and put into a better companies. Okay. So let me move on to another company. Okay, I'll move on to a few companies before I end the webinar session. But if you have any question, you can just type it in the Q&A. I will just look at the Q&A and see what can I answer. Okay. Okay, Okay, I saw one of you have Taising Electric in your portfolio. So when I look at Taising Electric, right, I think currently the business is enjoying a very, very good tailwind. Okay, so that's why they are doing very well right now. And one thing I like about Taising Electric is that the management is very conservative, and during crisis time, you definitely won't go bust because they have many years of experience. They have been through crisis. Okay, but right now, if you ask me to buy into Taising Electric, I probably won't, because I view Taising Electric as a fair company. Okay, and the price right now, right, I think it's 40 cents. I calculate their fair value is around 41 cents or 42 cents. And if I want to buy in such fair companies, right, I want to buy below intrinsic value. Okay, I want to have a buffer. So right now, I think Taising is at their fair business. Okay, and I would not want to invest in them right now. Okay, I want to have more buffer, maybe at least 40% or 50% below their intrinsic value, which give me a good margin of safety. Okay. Okay. So I saw some of you have Wilmar International inside your portfolio, which is a palm oil sugar business. All the majority of the commodity business is in Wilmar. And this business is, I would say, it's a very, very long-term business, and it's a very, very complicated business because not a lot of people knows that they own 50% market share in China's cooking oil. Okay, that's the consumer product that they own, and not a lot of people knows about it. And there are whole integrated chains, and I saw some of you, I think, make a, I think 50% loss. I believe you have bought 70 at $7, which is or $6, which is a very, very high price. Okay, at $6 and $7 for Wilmar, I think is very, very overvalued. Okay, right now Wilmar looks good, but it looks cheap right now. Just that you must know that if you look into this company, right, you have to invest in a very, very long time, maybe 10 years or 20 years. And I can tell you, our investors don't appreciate Wilmar. They won't understand because the business is too complicated. So it's very, very hard for this company, right, to reach full potential. Just to let you know the downside of this company. Okay. Next is companies like Balstec Singapore. I saw that in some of you requests to ask me to take a look. I also have been a shareholder of Balstec, and personally, I think that Balstec have one of the best management I've ever seen. It's just that the business model, only a part of it is actually recurring. Not part lah. I'll say Balstec project and the geospatials are recurring. So actually, they got a large part of it. And why the share price have fallen? Because they actually spin out their Balstec project. So it seems like they drop a lot, but actually, if you are a shareholder for both company, actually you still make money out of Balstec, and the management have always been very fair to the shareholder. So I think this company is quite a good company, but it's for long term. But the only concern about this company is the succession plan for Mr. Wong. Okay, he's very old right now, so I'm very concerned with the succession plan, whether his son is as capable as him or not. So we still have to monitor this company, right? I saw some of you have Raffles Medical inside your portfolio. Raffles Medical basically is they own clinics and hospital in Singapore, and also they have operation in China. And if I look at the valuation right now for Raffles Medical, I think it's quite high. Okay, the average PE for Raffles Medical is about 20 times. Now I think they're about 27 times. So I want to try to buy them at average or below average. And of course, people are banging on the growth of their China segment, but it's still too early to say that, and they are still making losses in their China division. So I'll still wait and see. It's a good company. I'll still wait and see for a good price to look into Raffles Medical. MTQ, Chicago Bridge, and Iron, these two companies, I think, are all oil and gas related. So any oil and gas related companies, they are facing supply issues, excess supply issue. I won't want to be in the oil and gas business right now. Okay, I'll try to look somewhere else. Naratel, one company that I used to invest because of their payment solution business, and they are in the past they're very recurring because of payment solution, and the board decided to sell off the payment solution, and after that the CEO resigned. So this make me I got a big concern about this, and I immediately sold my share. But luckily, because I paid at a very cheap price, I still make money out of it. so I didn't make any losses, but I cut it fast. Okay, so and now their business are very, very lumpy in nature, and I won't want to be in Naratel right now, and I don't know who's the new management. I didn't really track them right now. Okay, let me see, still got what company. Okay, Nordic Group. Nordic Group have been doing very well. Basically the founder, not the founder, the chairman, is a very smart allocator. He know to do good acquisition and buy and acquisition you accretive to the business. But I got concerned about Nordic is because they change their CFO very regularly. They consistently changing their CFO. So this one thing I very concerned. For the past year, I think they changed 4 or 5 times already. Okay, so I'm very concerned about this thing. So there's one thing that I also still clear from this company because of the change of the CFO quite often. It's too often already. So I'm very concerned about that. Okay. So yep. Let me see. If you have any question, you can type in the Q&A box. If not, I'm just going to talk about another maybe one or two companies, or okay, I can answer about some of your questions. Okay, suddenly I saw a floodload of questions here. Give me a minute. Whoa. Okay, let me take a look. Somebody asked about Silverlake Axis. Basically, Silverlake Axis is in the past they have been slammed down by the short seller that they are fraud company. Okay, but of course they have a structure that is very prone to fraud. Okay, but after I looking at the behavior of the management and the business at itself and asking around, I don't think this company is a fraud company. Okay. Somebody say F&B is quite recurring in that sense. Yes, F&B business is very recurring, just that it's also very competitive in nature, and F&B requires consistent upgrade. If the founder itself do not know how to upgrade the business, right, the business will eventually go off, or they drop in quality of food, right? Eventually nobody will go eat that company. You look at sake sushi, it's almost gone already. Okay, Keppel Group, personally I don't really like Keppel Group. I don't like anything related to Keppel. From the way how I track the management behavior, I think they have a lot of issue, especially from the top management. That's why it brings down to the bottom management. That's why now you see that they got so many issue of corruption and a lot of things. So I don't really like Keppel Group. Okay. Let me see what other questions. Somebody asked about Perennial Holdings. Perennial Holdings is a very long-term company. They are building on a very long-term dream of medical properties, and not only in Singapore but also in China. And of course, with recently they finally settled the capital business is a good way if they can. I don't know, they want to buy or they sell. If they sell, basically they can unlock a lot of money and reduce their debt level. Okay. Let me see what's some of the latest question. Oh, okay. Let me see. Okay. Maybe I just answer one or two companies. I saw DKSH inside here. DKSH is one company that in recent years their share price has fallen a lot. Okay, it's partly because they changed from an asset heavy business to a asset light business. So now they are more light. They want to expand more, so they sell off all their property and they rent it right now, which is good for them. So that's why you see their costs ramping up also, but their business is very light. They can scale up faster now, because last time if they want to expand, they have to buy a property, then they expand, buy a property, expand. So that's very slow and very capital intensive. So then they now want to expand, they just rent the place only. That's why you can see their earnings drop, because their rental expense actually increases. The first thing. Second thing is because of the consumer behavior in Malaysia, because of the GST up. That's why they are a lot at that point of time. That's why a lot of things hurt their earnings. Okay, I think DKSH still need a long time to stabilize all their earnings and build up the growth back. Okay. Okay, let me see what's the other company. Somebody asked me about how about wait, let me see. Okay, how do I stretch this thing? Give me a minute. Okay, somebody asked, how about Taiwan Semicon Manufacturing Company? Actually, I never see this company before, so I cannot give much comment on that. Any advice on MM2 Asia? MM2, of course, recently they bought into the cinema business, which is much more of recurring. But their main business is actually the film production, which is non-recurring. Okay, but of course, if they are cinema business and plus their film, they can do quite well. So I'm also monitoring this company, but I don't think now is a good thing to look into them. I don't think their valuation is cheap. So I still not need to take a look. And I see the way they paid for Cathay, right? Actually, the amount they paid was quite reasonable. So it's still okay. Okay. So with that, now it's about 10 p.m. right now. So give me a minute. So right now it's about 10 p.m. and I come to the end of the webinar. Thank you for staying throughout the whole 1 hour of the webinar. And I hope you learned something. I hope I helped to give some advice, not say advice, my personal opinion on the different types of companies. Okay, and do remember it's not a recommendation or buy or sell. Okay, it's just my personal opinion. You can take it as a feedback, up to you. But the decision is still upon yourself. So if not, thank you so much, and I will see you in the next webinar next month. Thank you.